If you were to point out to a chart that shows what was a regime shift and what asset class would show that, one of them would be this one. Because you would think, imagine you're trading this and you see 2-year yield actually hitting, this resistance line and falling every time. And every time we've seen this was actually a big recession. And this time now we went through it. And as we went through it, a lot of people thought, this is what is going on? I'm lost. And I thought this was going to hit resistance and go back down. This is what it causes when you get into an inflationary era, when the Federal Reserve and other central banks that never dealt with this issue are having to deal with the problem in a delayed manner. That's why we saw many central banks in developed world economies having to deal with the inflation problem much later than emerging markets. It would be now plausible again to see this go back to the resistance line, which would be forming a support in this chart. And that would be around the 2% area. That is a massive move. For those who don't know, I don't know if you're going to have the chart there, but if there is a chart that I posted that looks at the 2-year yield versus gold.
Tavi Costa stated that if the 2-year yield drops to 2%, we could see a massive rally in gold. He explained that gold has been consolidating after hitting the $2,400 mark, and before that, it broke through the $2,000 level, a point many believed would act as a triple top. Despite some predictions that gold might fall back to $2,000 or even below $2,800, it has held up well, partly due to an implied decline in the 2-year yield. Costa also mentioned that a move to $3,000 for gold shouldn't surprise anyone if rates drop to 2%. He highlighted that such a shift could drastically change the fundamentals of the mining industry, especially if interest rates fall and gold rises to around $3,000. Additionally, Costa noted that silver is extremely undervalued, and other metals like copper are showing resilience despite market declines. He likened holding metals right now to trying to hold a beach volleyball underwater. It's poised to explode upwards. Even when the market dips, Costa observed that metals are holding up well, which suggests that once the current storm passes, these assets could reach much higher levels. He is extremely bullish on this space and advocates for a long-term perspective, citing significant opportunities ahead.
I emphasize the yield curve quite a lot. And I think this indicator is also important because it looks at labor markets. And the labor markets have some uniqueness and some other things that are very part of the cycle. Things that are part of the cycle are the fact that we're seeing a trend higher in unemployment rates that is being caused by just a normal problem of corporations. If we looked into job openings, for instance, the number of government jobs relative to private companies actually hiring people, clearly we're seeing a shift there where government jobs are becoming a larger percentage of the labor market. And that's been the case for some time now. That trend has been higher. And every time we see that, it's a recession signal. So labor markets are showing cracks, and it's very important to pay attention to that. However, even from the number of immigrants that we had recently, the surge of call it illegal immigrants that we've had, that is also adding to the uniqueness of the labor market today. That it's important to point out because most of those folks are actually unemployed now. And so that's increasing the unemployment rate in a significant way. So that's one segment that is slightly unique of today. But in my view, labor markets are cracking regardless, and it will probably continue to see this trend. And I think it will be impeccable at the end of this cycle, another time that this indicator has proven to be right in terms of predicting a recession. But the last thing I wanted to point out in this chart is that we all have an obsession looking at labor markets and inflation to sort of see what happens with Fed policy. But at the end of the day, it doesn't really matter. All you got to look at is how much interest payment we're paying relative to GDP right now, not only with the US alone, but relative to the other places in the world and other developed economies. The US is about to spend close to 4 to 5% of GDP on interest payment relative to the economy. At the same time, if you look at places like Japan, Germany, Canada, they're all below 1%. So there is an inconsistency of the policy rate of the Fed versus this growth in the debt problem that we're seeing. And that adjustment is going to have an impact on the dollar. So I've been actually very bearish the dollar, believe it or not. And I think it's remarkable what we're seeing in terms of the sell-off in NASDAQ and S&P that is not also causing the dollar to appreciate, as we tend to see. Remember, people have margin calls, and what do? They buy the dollar. Why is the dollar not going up? It has to beg the question. I think there's some much more structural shift happening right in front of us, of capital flows out of the dollar, for those reasons I just mentioned, inconsistency of interest rate policies versus other places in the world. And that's going to have an impact that will likely weaken the dollar as well much further.
Tavi Costa stated that he places significant emphasis on the yield curve, considering it a crucial indicator because it provides insights into labor markets, which have their own unique cycles. He pointed out that we're currently seeing a trend of rising unemployment rates, driven by typical issues within corporations. For example, Costa noted that the number of government jobs relative to private sector hiring is increasing, indicating a shift. This trend has been ongoing for some time, and Costa believes that whenever this happens, it's a strong recession signal. He stressed the importance of paying attention to these cracks in the labor markets. Costa also highlighted the impact of the recent surge in illegal immigration, which adds another layer of complexity to the labor market. He mentioned that many of these individuals are unemployed, which is significantly increasing the overall unemployment rate. While this aspect is somewhat unique to today's labor market, Costa believes that labor markets are cracking regardless, and this trend is likely to continue. He expects it will have a significant impact by the end of this cycle, reinforcing the yield curve's reliability in predicting recessions. Costa further pointed out that while there is an obsession with using labor market conditions and inflation to predict the Federal Reserve's policy moves, the real issue lies in how much the U.S. is paying in interest relative to GDP. He noted that the U.S. is approaching a point where it will spend close to 4% to 5% of its GDP on interest payments, compared to countries like Japan, Germany, and Canada, which are all below 1%. This inconsistency between the Fed's policy rate and the growing debt problem, according to Costa, is going to have a significant impact on the dollar. Costa revealed that he has been very bearish on the dollar, finding it remarkable that the current sell-off in NASDAQ and the S&P hasn't led to the typical appreciation of the dollar. He questioned why the dollar isn't rising despite margin calls, suggesting that a structural shift is happening, with capital flowing out of the dollar due to inconsistencies in interest rate policies between the US and other global economies. He believes this shift will likely lead to a further weakening of the dollar. As gold approaches the $3,000 mark, Costa emphasized the profound implications for silver. Historically, silver tends to follow gold's movements, but with greater volatility. He indicated that a surge in gold prices could lead to an even more significant rise in silver, especially given its current undervaluation. Costa underscored the importance of closely monitoring these developments, as they present substantial opportunities in the silver market, driven by the bullish sentiment surrounding gold.